Hey, we're jumping here, jump up here. Okay, hi y'all. It's a time to start class. Looks like we only have 1, 2, 3, 4, 9 people maybe here, so it's a little low attendance. But so the first thing I'm going to talk about is kind of finish up our discussion about bonds, which is chapter number 7, and I wanted to do that with the issue of Neiman Marcus. I don't know if all of you have heard about Neiman Marcus. It's a high-end department store, and it looks like it's been coroned. And I've got an article up here I wanted to read to you, but it has everything to do about bonds. So that's why I wanted to connect that with the class today. But anyway, so a group of investors in Neiman Marcus plan to challenge the $600 million financing package that the department store operator has arranged for its imminent bankruptcy. Instead, Murdoch Capital Management and Daniel Loeb Hedge Fund, Third Point LLC, are calling for the retailer to find a buyer instead. And this is according to Reuters. Murdoch recently submitted a $700 million proposal to Neiman Marcus for debtor in possession financing, a deal with terms that would require an attempt to sell. So we've got a little bit of an issue going on here with Neiman Marcus. They are clearly attempting to move into bankruptcy, which would put bondholders at risk. And of course, if bondholders are at risk, you've got equity holders at risk as well. But the question is, should they get into more debt to try to save themselves, which would put the old debt holders that are senior to the new ones in jeopardy, because it pushes their leverage up even more. And that was one of their fundamental problems, is that they are highly levered. And then on top of that, they've got some liquidity problems going on because they haven't had people in their stores now for over a month. So they've got liquidity issues that have spun off of the debt issues as well. The investors believe Hudson Bay Company, the owner of Saks Fifth Avenue, would be the obvious, logical buyer. However, Neiman Marcus plans to use $600 million loan from creditors, including the Kempner Capital Management and Sixth Street Partners instead. Its current plan would ask creditors to forgive. That means completely lose their investment. Forgive most of its $5 billion in debt in exchange for ownership stakes in the company. So what Neiman Marcus is doing is they're trying to get their debt holders who are higher up on their balance sheet to forgive the $5 billion in debt, to convert their debt into stock, right? So to move down on the balance sheet. The debtor, the credit holders are saying, no way, no. You've got a buyer out there, obviously, and so why not have Saks Fifth Avenue purchase this joint and leave our debt intact the way it is? So there's an argument going on here. A bankruptcy judge has final approval of the retailer's financing, and the investors behind the new proposed loan plan to argue in court that their fees are less expensive. Neiman Marcus's pending bankruptcy could be a devastating blow for Related and Oxford Properties Hudson Yards Mall, as it would force the owners to renegotiate the company's lease and have conversations with the retailers that have lease agreements linked to Neiman's presence in the mall. So Neiman Marcus is actually one of the big box companies that is an anchor in a lot of different malls across the country, particularly high-end malls. And so this is not only going to have an impact on Neiman Marcus's debt holders, but also on real estate values in these malls. So there's a lot of people that are stakeholders here in what happens. Anyway, so I just want to bring that to your attention. Neiman Marcus is an old name that a lot of people would recognize. It's a very high-end department store, and they're having difficulties rooted in their debt, number one, and then the liquidity issues, number two, that typically happen after the debt issue is a problem. So looks like the bondholders are in a bit of an argument about how this should be handled, and they do not want to be reduced to become equity holders. They want to keep their debt intact. They also think it's more appropriate for someone to come in and buy them up in a whole instead of letting the bankruptcy occur. Any questions about the Neiman Marcus issue? All righty, well then we're going to go ahead and...
I had a question. Are they going to give him like, are they going to give him equal amount of stock, or would it be like 2 to 1 to the dollar or something like that? Or they don't really say that.
That would be in the negotiations. And bottom line is, whatever that ratio of debt to equity that they would receive, the bet is that Neiman Marcus ends up surviving. That's what they're trying to do, is they're trying to unload their leverage right now. It's too much for them. It's been too much for them. Coronavirus just tipped them over the edge. And so really, my first thing, if I were a bondholder trying to be pushed, if they're pushing me into the equity section of the balance sheet, I'd be worried first and foremost if the equity was worth anything, right? You could give me all the equity shares, and if it doesn't survive, then it's worthless, right? And so you lose not only your debt position that you held, but also you're likely to not have an equity position that was worth much. So yeah, that would make a difference somewhat about that ratio, that exchange. However, I really think this is a total bet on whether or not they actually survive as an entity at all. That's a good question though. Any other questions? Okay, so I'm going to do a little bit more on the bonds before I start stocks. And a little bit more that I wanted to do has to do with, where are we at down here? Okay, so there are a number of different kinds of bonds, and one of them are floating rate. And so last class period, we had a bond, we talked about municipal bonds, but I'm going to give you an example of a bond where we've got a 10% coupon, what we've been using, paid annually, and it's a 5-year bond. And $1,000 par value. It's loaded just exactly like we did all the problems with. And let's say that we have a 7% yield to maturity, and here's the price today, the present value. This bond's value today is just going to be 100 divided by 1 plus 0.07 raised to the first power plus 100 over 1.07 raised to the second power, all the way out to the last 5th period where we've got $1,100 plus 0.07 raised to the 5th power. All right, so how a floating bond works is that these coupons float with an index, and it might be a treasury index. It might be an index called the LIBOR rate, London Interbank Offer Rate. But the bottom line is that as interest rates go up, the coupons will also go up, right? Which means that floating rate bonds, the thing that makes them special is that not only will the denominator, as interest rates rise, the interest rate in the denominator will rise, but also the coupon payments will rise, which basically means that as the interest rates rise, the longer the term the bond, the more sensitive it was to interest rate changes. So in other words, interest rates go up, price falls by a lot if it's a long-term bond. If it were a floating rate bond though, what happens is there's this offset. Both the denominator and the numerator increase, which causes the value of the bond to be more stable. So if you believe that you're entering into an environment where interest rates are going to rise, floating rate bonds are sometimes the solution. Because if you had a fixed rate bond and these $100 coupons did not change when interest rates rose, then you're going to have a price decline. And the longer the term the bond, the bigger the price decline. And so that's why floating rate bonds kind of exist, is to be a little bit more stable prices. There is also a type of bond, it's called a inflation index bonds. And in fact, with the government, our United States Treasury issues something called TIPS, T-I-P-S. And these TIPS, TIPS, is Treasury Inflation Protected Security. And how they work is that the coupons stay constant, just like in our old vanilla bonds, but what doesn't stay constant is this par value. So the par value inflates with inflation, and inflation is typically measured by the CPI, Consumer Price Index. And so if inflation occurs, typically also interest rates rise at the same time. And so you end up with rising interest rates in this denominator, which pushes the price down. But with inflation indexing this par value, you get this one lump sum at the tail end of the bond that's inflating as well. So in other words, you won't necessarily get back just $1,000. You might get back $1,030 if there is a 3% inflation, right? And that this is another offset, which actually causes the value of those bonds to be a little bit more stable and less volatile. And so in times of when you expect high inflation, you can actually purchase inflation-linked bonds or inflation protected bonds, and that will offset some of the decline in the bond value, if not all of it. You can use TIPS to actually back out the expected inflation rate, and that's what oftentimes they're used for, because the market will have a price given to you for the TIPS. You will know the coupon, right? And you will know the original par values. And this original par value will inflate. It'll be like $1,000 times 1 plus the inflation rate, raised to whatever time period we're talking about. So maybe to 2 years or 5 years down the road, 5 years down the road. And you'll have everything filled in except for that inflation rate. So this is actually a security in which a lot of people use to try to estimate what inflation is going to be on average over the term of the bond. So in this case, it's 5 years. And so it'd just be basically solve for the inflation rate that is causing this par value to rise. And so nothing that you're going to have to do for a test, just some reasoning for why TIPS are so valuable, or so many people watch them so closely. I also had an accounting student who was a finance major as well. We get into TIPS a lot more in my Finance 401 class, which is money and capital markets, and I actually do the math to back out the inflation rate. So I'm telling you about the math, but I'm not going to do it for you. Well, we did it in his class, his upper level class. And then I think he took the CPA a semester later, and he said there was an exact question like that on the CPA, which I was surprised about. So anyway, so there's a reason to look at TIPS and understand how they work, right? Well, why would you be concerned about inflation? Anybody? Anybody worried about inflation now?
Because by the time the bond matures, it might not be worth, near as much as it was whenever you first put the money into it.
Absolutely. I mean, so this bond, this set of cash flows that you have purchased, basically, this particular par value, the principal, if this is a 5-year bond, long enough for me here, because between now and 5 years, what will that $1,000 buy? When it's a fixed rate vanilla bond, you get $1,000 back at par. Well, today I know what $1,000 will get me. It's maybe 2 months of rent. I don't know. That 2 months of rent in a 1-bedroom apartment, or that might be 3 months of food. But 5 years from now, if there's inflation, that $1,000 might not buy you much. Maybe it buys you 1 month of rent instead of 2. Or maybe it buys you a month and a half worth of food instead of 3. And so that's called inflation risk. And so with that said, that's why TIPS exist, and that's to reduce the inflation risk of that par value. So it allows that par value to actually increase. All right, so Treasury securities, we talked about bills, notes, and bonds. Treasury bills are a little tiny bit different than notes and bonds in that they have no coupons. And so that means they have 0 coupons, and that they will always sell at a discount from par because of the fact that there's no coupons. And other than that, there's all different kinds of bonds. So kind of the sky's the limit. I've just put down a couple bullet points here for different types of bonds. Catastrophe bonds are an example, which are oftentimes issued, might be by a municipality in which has been hit by a hurricane, for instance. These would be bonds that would be issued, debt that was issued to pay for rebuilding. So that'd be a catastrophe bond. An income bond we talked about before. Typically bonds are not created originally as an income bond, but for instance, like Neiman Marcus now, they're in distress. One of the possibilities, it doesn't sound like it's on the table now, but one of the possibilities as bondholders who do not want their debt that they hold converted to equity, they may offer up a different option, and that option might be to convert their debt into income bonds, meaning that the debt is not erased like Neiman Marcus would like to do, but the debt doesn't have to be paid. The coupons don't have to be paid unless Neiman Marcus earns income. And so this is usually when the bonds have typically fallen in value because there's a lot of question about whether the bonds are going to be worth anything. But the income bonds are something in which maybe Neiman Marcus bondholders might throw up as a possibility rather than converting to equity. Then you have convertible bonds, and this is kind of what Neiman Marcus is being asked to do now. Is it's a bond, originally debt, with a conversion option into equity, right? And this would be a certain ratio of bonds to equity. In other words, you could convert your bond into equity at a certain conversion rate. Usually, though, this is not like the case of Neiman Marcus. It's likely that the equity may not be worth anything. Convertible bonds oftentimes they start out as a convertible bond, and the idea is that the company does well and that equity is worth a lot, then the bondholders are willing to convert their debt into equity, which then has a big impact on the company's capital ratios, right? Then put bonds. A put is an option. Like we talked about callable bonds. Callable means an option to buy. Well, a put is an option to sell. And so a put bond is where you've got your normal bond in which a put is actually embedded in the bond. This is basically acting like a guarantee from the issuing company, because they are saying, if you buy the bond, let's say Alvin buys the bond from me, and I'm the company and I put a put on this bond. I am telling Alvin, I'm giving you the option to sell the bonds back to me at a specific strike price, right? And so I'm basically saying, Alvin, I know I look risky right now, but I'm willing to guarantee these bonds because I will buy them back from you if they go bad, right, for a certain price. So it basically puts a floor on his losses. Puts were being embedded on some very complicated bonds in the financial crisis. And it was when they started putting a put on what they call collateralized debt obligations and collateralized mortgage obligations at Morgan Stanley. I saw a report, and that's when I said, oh no, things are going to go bad here, and I need to get out of the market. Because it's basically Morgan Stanley saying, hey, we can't sell these bonds otherwise, so we're going to have to put our guarantee on it, right? And so they put a put option on it saying that we'll buy it back. Them buying it back is contingent on the fact that they still exist, all right? So that was an issue that I saw come up in the summer of 2007, which was nearly a year before our market started to melt down. But that was a little piece of information I just happened to read in an article, that puts were being placed on some bonds to get them sold. Otherwise, I don't think they could have. So it's kind of like putting some sugar on the bond to make it a little bit more palatable for the investor. Any questions about any of those? All right, well, I think that's about really all I want to cover in this, this section. So I'm going to go ahead. I think we already talked about the quotes. Did we do that in this class last time? I know I did it in one of two of the classes. Have you seen a quote? Okay, so it must have been the other one. Just so you guys know what you're looking at here on the Treasury quotations. The first column is always a maturity. You know, like in your problems, you're always given some very nice, clean 2 years to maturity or 5 years to maturity. In reality, you're given a date, right? And that date here, you can see it's February 15th, 2036. So with that said, it's 16 years away. And in fact, we'd have to actually count on our fingers and toes how many days that is even. It's not an even 16 years. All right, then the next column will be the coupon. And the coupon is 4.5%. And that is always multiplied by the par value. Par values are typically not shown in the quote, right? Everything is put in percentage terms. And so instead of seeing a par value of $1,000 and a price that's 900 and some dollars, you'll see prices actually in percentages of par. And so you can see here like the bid, there's a bid and there's an ask. And so the bid and the ask comes from the dealer's point of view. So what they're asking for the bond is what you can buy it for. And so in this case, it's 128.1406. All right, so this is the price the investor can purchase the bond for from the dealer. The bid is 128.0781, and this is the price that the dealer is offering. Sometimes they actually call it the offer rate. And so the bid is what the dealer is bidding for, what they're willing to offer to you. That's what you can sell at. So the price the investor can sell at to the dealer. All right, so these are both in terms of percentages, and you will see this quoted differently on different websites. So I'm going to take the ask right here. That is telling me it's 128.1406% of par. So it doesn't matter what your par is. It could be 1,000, could be 100 million, doesn't matter. You can always figure out what the price that you would have to purchase it for based off that quote, right? Now, sometimes you'll see some of them, they'll say 128, it'll be a colon, and anything after the colon is in 30 seconds. So I'm going to make this number up. Let's say it's 128 and 23, right? This is the way the Wall Street Journal used to actually quote. This is equal to 128% of par in 23:30 seconds. That's percent of par. So that's a different form of quote, right? So it's just super confusing for people. You have to figure out wherever you're looking at on the internet, what their notation is. And you'll find they're different oftentimes. All right, any questions about, let's see the change here, that's 0.7031. That's the change in the ask price from yesterday's close. All right, so yesterday when it closed, it looks like the change, it went up by 0.7031 since yesterday. And then the yield is your R, your interest rate, your yield to maturity, and it is always based off of the ask price. So we rarely, never use the bid price for many calculations. We always use the ask price when we're forced to calculate a yield to maturity. And so that ask yield has been calculated for you. All right, any questions about any of that? I could put this down on a timeline. And so actually this is February 15th, 2036. And gosh, how long is, we're past February, so we're talking about a little less than 16 years, but I'm gonna pretend like we're on February 15th, 2020. And so it's exactly 16 years. So I'm not dealing with a bunch of dates or days. We got 16 years to maturity. There's actually 32 6-month periods in all of these bonds. It's at 4.5% interest. That means that if you're going to, and when you're looking at a quote like this, I like to make the par 100. That makes it easy in my head to calculate. So if the par is 100 and the coupon is 4.5% of 100 per year, that's $4.50. Then, so $4.50 divided by 2 every 6 months is that annuity. All the way out to the 32nd 6-month period. And then you get your $100 par back. Then the yield to maturity they've calculated is 2.618%, and that's per year. And then the ask price is $128 and about 14.06 cents. And it's made easy because I've made the par 100 rather than 1,000. Does that make sense to everybody why I would do that? Yeah. This same timeline can be done this way. 32 months, and the value every 6 months of the coupon would be $45 divided by 2. All the way out to 32 semi-annual periods, plus $1,000 par value. Interest rate still 2.618%, and the price of this bond would be $1,281.406 would be the price that you had to pay. Does that make sense to everybody? Both of them are same identical timelines really, but I think it's easier when you're looking at a true quote to assume the $100 par value because everything's in percentages that way. Any questions about a quote? All right. All right, I'm going to move on to stock, which is chapter 8. And there are 3 different kinds of problems we're going to work for stocks. So those three different kinds of problems, they're super easy. The first two are super easy. I think the first thing we need to do though is talk about what the difference is between stock and bonds. And the idea here is that stock is further down on the balance sheet. It's at the bottom of the right-hand side of the balance sheet. It's a form of funding for the company that is basically your residual claimant. It's whatever is left over at the end of the day is what you get. And this first little section I'm going to do is all about getting the idea of what you own when you own a stock. First of all, you do get voting rights, right? That's one perk, that you have some say in how the company's run. You have some say in who is on the board. But what you're really after here, not just the voting rights, but also cash flows. Just like with a bond, you're after cash flows. And with a stock, the cash flows are dividends, right? Now, the first little example I'm going to give you here is one in which is the whole idea here is to show you that no matter how far out we push our dividends, because stock doesn't mature. So a bond, like we just talked about, it matures. A stock never matures. It goes to infinity. And so I'm going to first show you that a stock is kind of like a bond, but we don't get coupons. The dividends are our cash flows. The coupons are, in a bond, are required and they're an obligation to be paid. Dividends, no, they're not. So if you don't get paid your dividend, then you don't have the power as a stockholder to push the company into bankruptcy. So let's take this first example. It says if you buy a share of stock, you receive cash flows in two different ways. One is when they pay dividends, right? So when they pay dividends, you get a cash flow. It's not guaranteed, and you don't necessarily know with certainty what that dividend is going to be. You can guess, but it's not certain. Not like with a coupon with a bond. With a bond, that coupon is required and it's an obligation. You know when it is due, how much it is going to be that's coming to you. Stock, the dividends are not known for certainty, and there's not also that there is this issue of do they have to pay them or not. The other way that you have cash flow from a stock is that you might sell your shares at a premium, maybe from what you bought it for capital gains. So you might sell it for a capital gain, but you might sell it for a capital loss, all right? It just depends. But the idea here when we price a stock, it's just like a bond in a sense. We're just taking the present value of our future expected cash flows. That's all we're doing. It's just that these cash flows are not set in stone with certainty. With a bond, at least we know that they're obligated, that interest and that principal, we know when the payments are obligated to us. All right, so here we have this example. Suppose you're thinking of purchasing stock in Moore Oil Inc. Oil industry's kind of been under pressure lately. If you guys have noticed, you expect, and that is very important, that you expect it to pay a $2 dividend, right? That means that that's forward here. That's not behind us. It's not that we've already received. It is that we expect in the future a $2 dividend in 1 year. You also, if you're a genius here, I guess, believe that you can sell a stock for $14 in a year. Well, whoever thinks that is probably pretty smart. But this is that information on a timeline. Basically, you're expecting after 1 year that you're going to receive $2 in the dividend and $14 in the value of the stock. Now, you think this is pretty risky, and you'll notice that with higher risk, you're going to be requiring higher returns than you did with those bonds, right? You require a return of 20% in order to invest in this stock. question is, how much is this stock? What's the maximum you're willing to pay for that today? Well, all we're asking is, what's the present value? So the price today is going to be $2 plus 14, which is 16 bucks. And we're going to bring it back one time period, which is 1 plus our discount rate raised to the first power. And that turns out to be that you'd be willing to pay $13.33 today for that stock, if that's the assumptions that you're making about it. Now, do you see how severe those assumptions are? I think this $14 assumption's really severe because I don't know what's going to happen tomorrow, let alone a year from now, right? All right, next, I want to show you though, now let's say you decided to hold it for 2 years, right? And you expect that not only are you going to get that dividend that you expected after 1 year, which was $2, but in 2 years, you expect to get another dividend, which is $2.10. So in other words, this dividend is growing on you. It's pretty common for that to happen, actually, on a stock. And then you also are this genius that thinks that they know what the stock price is going to be in 2 years, and that price is $14.70. All right, so question is, what is the value of that stock today? So in other words, we just pushed this decision to sell out 1 extra year. So the price of this stock should be $2 that we're going to receive in 1 year, brought back to present value terms, which is $2 divided by 1.2 raised to the first power, plus then $2.10 plus $14.70 divided by 1 plus 0.2 raised to the second power. Turns out when you do that math, that's still $13.33. Same number. So you may have any idea what's going on here in this example. We've got a growing dividend, and our price is also growing, right? That we're anticipating. And it turns out that growth rate turns out to be really important, right? And bottom line is, if that growth rate in our dividend and the growth rate of our capital gains is constant over the life of this stock, then we can just keep pushing this decision to sell out into infinity. And the bottom line is, then we have this simple little equation that we can actually use. And that equation is that the present value, or the price of the stock today, is equal to the next period's dividend, all divided by our required rate of return minus our growth rate of dividends. So D1 is our next dividend expected. R is still our same old R in our equation, which is our required return. G is our growth rate of dividends. And this G is a constant. It doesn't change. That's important, right? Okay, so with that said, I'm going to kind of go through here, and we've got 3 different possibilities for problems. The first one is where we have a constant dividend. So a constant dividend model is where G is 0. There is no growth rate. And our dividend is the same every single period. It does not change. It would be like having a preferred stock. That's how preferred stocks work. They have a constant dividend. Preferred shareholders don't get to vote, but they do get preferred dividends. In other words, they are before the common stockholders in getting their dividends, and it is typically a constant dividend that they are receiving, right? So constant dividend growth model would be like having preferred stock, where G is 0. So in other words, the price of a constant dividend stock is just your dividend divided by your interest rate. Then we have a case where we could have a constant dividend growth. That means G exists, but it's a constant value. Might be 5% or might be 2%. This is where the firm is going to increase the dividend by a constant percent every period forever, right? And that's where we use this example, where this is a constant growth of dividends. And then the final one is where we call it supernormal growth, or sometimes you'll see them called non-constant growth. This is where the dividend growth is considered to be initially all over the place. They're not constant. Might be one number one year, another higher number the next year, a lower number the next year. And so it's not constant. But, so it's non-constant to begin with, but it settles down finally to be a constant growth eventually. All right, so these types of problems, we're gonna have to split up into 2 parts. These are the hardest ones. They're just a little time consuming, that's it. But the price is still computed as a price of the, it's the present value of all the future expected dividends. Just the beginning, it's non-constant, and then at some point, and this is really important, that it settles to a constant growth rate. So best thing to do is to start with a really easy question. If dividends are expected, and that word expected is really important, at irregular intervals forever, this is what we call perpetuity too. So this equation, what we had with a constant dividend where G was 0, this is a perpetuity. And it probably looks very similar to something we did earlier in the class where we had a perpetuity in a bond. In other words, bonds that never come due. It's exactly the same equation, except for instead of C in the denominator for coupon, we're replacing it with D for dividend. So it's exactly the same thing. So let's suppose that a stock is expected to pay. All right, so key here is the term expected to pay 50 cents every quarter, and the required return is 10%. All right, so required return is 10%. We've got quarterly payments coming, and our timeline now goes out to infinity, right? So basically, we're going to get a 50-cent dividend every quarter. This is first quarter, second quarter, third quarter, fourth, so on and so forth. So these are all in quarters. And we're going to get 50 cents every quarter. And that is forever. So this is a constant dividend, right? Meaning that the dividend does not grow. It's 50 cents constant forever. So we're going to use this equation. Price of this stock today is going to be our dividend divided by our interest rate, and we need to put this in quarterly terms, right? So the interest rate has to be plugged in quarterly. So our dividend is quarterly, which is 50 cents. We're going to divide that by 0.1, which is 10% annually. We're going to divide that by 4. And that turns out that the price of this stock, based on those assumptions, should be 20 bucks. Okay, now we applied a pretty high required return here, relatively higher than what we've been working with. And that's because there's more risk involved, right? These dividends don't have to be paid, right? They don't have to be paid. The company may cease paying dividends. And so they're not obligations. So that's the one risk. So the big risk is that these dividends may go away for a period of time. They may come back. They're not obligated. That's the bottom line. Makes it more risky. With more risk comes higher required returns. And let's say we're in today's world, which is pretty risky right now, right? Lots and lots of uncertainty. Right now, investors are increasing these required returns, and we're increasing the required returns on our investments because we have no idea what's going to happen in the second quarter, third quarter of 2020, let alone 10 years from now. And we're talking about an assumption here that we're going to receive 50 cents per year, per quarter, forever. So forever is a long, long, long time, and that's a big assumption to make, right? So with more risk comes greater return. And then when the markets change and the environment changes, we push that required return up, and with higher required returns, we'll see the price of those stocks go down, right? Because you're basically increasing this denominator, right? It's easy to see. All right, here's, this is the dividend growth model, and I'm just, instead of like going through the math here, I'm just gonna start working problems because we really already know everything we need to in order to work these problems. All right, so we get this company, it's called Big D Inc. And they just paid, and that's very important language. Just paid means it's in the rear view mirror, already happened, not part of the future cash flows that we're trying to calculate the present value of. But they just paid a dividend of 50 cents. That wording tells you just paid a dividend, that's D0 of 50 cents. The market requires a return of 15%. So R is 15%, and that is per year. If the market requires 15% on assets of this risk, how much should the stock be selling for? All right, so we know that they're expected also to grow these dividends by 2% a year. Important information. The growth rate of the dividends is 2%. So that means that, let me get a spreadsheet out so I can do the math a little easier. All right, so we're starting here at time period 0, time period 1, and time in these stocks go out to infinity. So I'm basically going to go to infinity on my timeline. And, oh, stop. 1,026 years. Close enough to infinity for me. I won't be around then. So it's not exactly infinity, but what you're going to see is how this works. Okay, so that's time. The dividend, it told me 50 cents had just been paid, right? Time period 0. That means that if it grows at 2%, I'm going to click on, I'm going to hit equal. I'm going to click on that 50 cents. I'm going to multiply it by 1.02. My next dividend should be about 51 cents. And I'm going to, oh yeah, it's right at 51 cents. And I've got this set up to where I can actually just copy this down forever to get all my expected cash flows, all the dividends that would come to me forever. All right, that was 1,023 years. Let's just check out and put some commas in here. You know, this 50-cent dividend over the course of my version of forever, which is 1,023 years. Let's see if I can find it again. Wow, if we could just live 1,023 years, we'd be getting a dividend that was over $314 million per year. That's at a growth rate of 2% a year. Okay, so all we're doing here is taking the present value of these future cash flows. Now, I'm not going to start here at that 50-cent cash flow because it already happened, so I don't want to count it. But what I am going to do is take the present value with an interest rate of 15%, a number of period. I'm going to click on that first time period because that 51-cent cash flow is going to be pulled back one time period. There is no payment here. I'm going to treat each one of these dividends as a separate individual cash flow. And then finally, the future value is going to be 51 cents on that first calculation. So that first dividend that I expect is in present value terms to me 44 cents. Now I'm going to copy this all the way down. All right, oops, close to forever there. Notice how the present value of these cash flows that are coming way out far in time are all 0. And it's because we're taking the present value, which is in this case, $199 million. We're dividing it by 1 plus our 15% discount rate, and we're raising it to the 1,000th time period, right? So you've got a denominator that is enormous, which is pushing that value to 0. And look how they're all pushed to 0. Let my computer kind of catch up. It's a little slow. But you can see that the value of those, even though those dividends are enormous, 871 years from now, they're over $15 million a year. They're worthless in present value terms, right? So we have to go way up here to find a present value of these dividends that have anything but zeros. You can see that they fall pretty quickly. In fact, everything after about 38 years is worthless, right? When I add up this entire column, I'm going to get the present value of all of my expected cash flows. I go down to the bottom, takes me a while. If I just say sum, or I could just do it easier by hitting that summation sign. $3.92 in value today, right? Okay, now let's do the math the easy way. So that's how we would have done it if we didn't have these equations. All right, so this timeline, the first dividend would be 51 cents. Let me go back up to the top so that I've got all these numbers down. First dividend is 51 cents. The second dividend is 52 cents. The third dividend is 53 cents. And they have a growth rate of 2 cents. And this goes on to eternity, and at an interest rate of 15%. Now our little equation though, the price today of that stock is going to be the next dividend. All right, so that's going to be 50 cents times 1 plus 0.02. That's our 52-cent dividend right there. All divided by our interest rate, which is 15%, minus our growth rate of dividends of 2%. So what we're doing is taking 52 cents divided by 13 cents, and you should get $3.92. Any questions about that? Big assumptions here, right? One big assumption is that this dividend of 50 cents that was just paid is going to grow at 2% per year forever, right? Next big assumption is that we've done some analysis on the risk of this particular stock, and we are associating that risk with a required return of 15%. That will change, right? Today, the required returns are much higher to invest in this market than they were 6 months ago, right? Which has caused all the prices of these stocks to fall in the market, right? All right, so let's try another problem. And I want you to make sure you're watching this wording. This is a company named TB Pirates, Inc. And it is, here's keyword, expected to pay. That's $2 dividend in 1 year. So that's forward, right? That's not behind us. That is in front of us. So D2, or sorry, our D1 is the value that they just gave us. So D1, because it's expected to pay $2 next year, interest rate is 20%, growth rate of that dividend is 5%. All right, so with our simple little equation, our price today is going to be equal to our next dividend, that is $2 divided by our interest rate, which is 20% minus 5%. All right, so $2 over 0.15, and we get an answer that's $13.33 again. Any questions about that? So in the PowerPoint, it asked, why isn't this $2 dividend multiplied by 1.05, our growth rate, like we did on the last problem? And the answer to that is because it's giving us our next dividend. It's already been multiplied by 1.05 for you, right? Does that make sense to everyone? So that language is super important, whether the dividend has been just paid or whether it's been expected to pay. So that's really important to keep track of. All right, so just a little example here of a graph. Along the x-axis, you've got your growth rates, that's the G. And then along the y-axis, you have the stock price. And if we graphed higher and higher growth rates, you'll see that it actually just kind of shoots off exponentially, right? When you look at this math, price here, dividend next period divided by R minus G, when G goes up, the whole denominator gets smaller and causes price to rise. And so that's what you're seeing, and it looks almost exponential in nature, right? So the higher the growth rate, the higher the stock price. On this case, and actually the x-axis is labeled incorrectly here on this graph. Sorry about that. On the x-axis, it should say required return, R. When R goes up, when our required return rises, that denominator gets smaller and causes the required return goes up, the whole denominator gets larger, making this whole right-hand side larger, pushing price down. So when interest rates go up, prices go down. Does everybody understand what monetary policy did about a month ago? Jay Powell, the Federal Reserve Bank, pushed interest rates down. The benchmark interest rate, Treasury securities, benchmark rate went down. This pushed some of the stock prices across the board up because of that monetary policy. So some of that policy is actually kind of inflating stock prices right now because they pushed artificially from the Federal Reserve Bank the rates down. Right? So these prices that we're seeing right now are being elevated partially by the Federal Reserve Bank's action, right? All right, here's another one. Gordon Growth Company. Here's the critical language. Is expected to pay a dividend next period, and dividends, and that's $4, and the dividends are expected to grow at 6%. All right, so because that $4 dividend is expected, that is D1. That's $4. And dividends are expected to grow at 6%, so that's G at 6%. And the required return, R, is 16%. So the price today is our next dividend, which is $4, divided by our required return, which is 16%, minus our growth rate, which is 6%. That's going to be 4 divided by 0.1, which is equal to $40. All right, any questions about that? All easy, huh? Okay, so now we have an example where it's non-constant. So the dividends are going to be all over the place. It says, suppose a firm is expected to increase their dividends by 20% in 1 year, and then by 15% in 2 years. So I need to draw a timeline here to keep track. So between now and 1 year from now, it's going to increase by 20%. After that, then it's 15%. So between 0 and 1, the growth rate is 20%. Between year 1 and year 2, the growth rate is equal to 15%. And then after that, the rate becomes constant at 5% forever. That goes to infinity. So it's not until period 2 that we get this constant growth, right? So we're going to have to split this up into 2 separate parts. We've got a required return of 20% on this stock. So we have to figure out what the dividend in period 1 is, and we have to figure out what the dividend in period 2 is, and then we have to figure out the dividend in period 3, and we could go on and do it the hard way, or we can split it up in 2 parts. So it says that the last dividend, and this is important, the last dividend was $1. So if it grew by 20%, So D0 is $1. D1 would be $1 times 1 plus 0.2, which is $1.20. And then D2 is going to be D1 times 1 plus 0.15, which is $1.20 times 1 plus 0.15, raised to the first power. And what does that equal to? I think I have it in here, $1.38. And then D3, and I'm going to draw a line here. After the second period, our growth rate becomes constant. And D3 is going to be D2's dividend, which is $1.38, times 1 plus 0.05, raised to the first power. And that turns out to be 1.449. And we can stop there. I could put this into Excel, do it the hard way, go out to infinity and find the present value of all of the dividends expected forever, or I could split this up. So I know on my timeline, I'm not interested in this $1 anymore because it's in the past. My next dividend will be $1.20, $1.38, and then 1.449. And what I'm going to do now is I'm going to find, using our constant dividend model, I can find the price of this stock right where the dividends begin to rise in a constant fashion, which is at period 2, by taking the dividend in period 3 and dividing it by R minus G. So this is going to be equal to our third period's dividend, 1.449 divided by 0.2 minus 0.05. We get a number there. That's $8.67. And what that number represents, this summarizes all dividends from time period number 3 through time period infinity into one single number. All right, so basically I'm going to redraw this timeline, and I've got 2 time periods now. First time period, I still have $1.20 dividend. Second time period, I still have my $1.38 dividend, but I have also summarized time period 3 all the way to infinity in one single number at time period 2. So I've got 2 values here at time period 2, $8.67 and $1.38. My discount rate still 20%. And now what I have is a simple mixed cash flow that I can compute the present value of in Excel. So I'm going to come over here to Excel. I got my time period and my cash flows. Time period 1, I have a cash flow of $1.20. Time period 2, I have a cash flow that's 2 parts. One is $1.38, and then I'm going to add to it my $8.67. All right, for a $10.05 cash flow. And then I'm going to find the present value of the 2 together. So I'm going to take present value The interest rate is 20%. The number of periods on that first cash flow is 1. My payment is 0. And my cash flow or future value, I'm going to click on the 1.2. All right, once I have that done, I'm going to copy and add up. Whoops, sorry guys. You guys should have caught me on this. This value right here was not 867. When you plug that into your calculator, it turns out to be 966. And so down here, sorry about that, I misread. So I need to go back and fix my spreadsheet. Right there, instead of 867, it should be 9.66. And there we go. The value of that stock today would be $8.67. And that is a non-constant or supernormal growth. Any questions? I gotta give up my classroom to my husband, so I gotta get out of here. Any others? See you guys on Thursday.
Bye-bye.
Bye-bye.